All right, hey, what's going on? This is Dan Keller, your mortgage advisor at Guild Mortgage. I want to welcome you to another episode of Making Sense of the Markets. Today is Friday, December 15th, episode number 51. So 51 weeks in a row, I've come to you with a market update and some valuable information that you can use or that you can share. And this week, I'm going to answer a question that has been thrown my way from past clients and a couple people that called me from online. And it's centered around, Dan, we own a home. What do we need to know? Is it even possible to purchase another home without selling our house? So I'm going to answer that question. I'm going to take you through the 5 or 6 part series, if you will, or 6 questions that I ask each one of those clients to arrive at a sound financial decision for you. First, I want to kind of give you a market recap and update you on the market because this is super, super important. I'm going to spend about 45 seconds on this. So this last week, the Fed announced that they raised the Fed funds rate 0.25% from 1.25 to 1.50. A lot of confusion in the marketplace. What does that mean? What's that going to do to mortgage rates? The reality of it is it allowed mortgage rates to get better. What the Fed funds rate is attached to is credit cards and auto loans and lines of credit and money market accounts, things that really are not directly related to your mortgage. So did it cause mortgage rates to go up? No, it didn't. Mortgage rates actually came back down. They're trending right at that 102.8 to 103 mark. What that means is that 30-year fixed rates are still in the upper threes depending on your down payment, your credit score, and type of property finance. So still a great time to finance a house. Do not be scared by that announcement. That simply means the cost of borrowing money outside of a mortgage just went up by 0.25 percentage point. So let's talk about you own a house and you want to maybe purchase another house, but you don't know if you need to or want to sell your existing house. Can you do that? Absolutely, yes, you can. There were some guidelines through Fannie Mae that changed in October of 2015 that allowed you to use departing residence income. So meaning they allowed you to not have to sell your house and just provide proof that there was a renter coming in and renting that house to offset your mortgage, and then we could remove that liability from your qualifying ratios, your debt to income ratios on your new purchase. So can it be done? Yes. This is what I do differently than other mortgage companies and banks. What I'm going to do is I'm going to take you through about a series of 6 questions, and it's going to start with I want to know what your current mortgage payment is. I want to know what your house would rent for, a kind of an approximate idea. Zillow will help you out with that. Craigslist will help you out with that. And I certainly will help you out with that. So I want to know what your mortgage payment is, what your house would rent for. I want to know what you owe on your house. I want to know what kind of mortgage you have, your existing mortgage on your house. Do you owe 22 years? Do you owe 28 years? Is your rate 4.5%? Is your rate 3.5%? I want to know what your home is worth. So I want to know what you owe, what kind of mortgage you have, and what it's worth. The other thing is I want to know what you have liquid in regards to cash in your checking and your savings account. If you were to purchase another house without selling your house, you're going to need a down payment. So I want to see what your liquidity situation in regards to for a down payment on your next house looks like. The last thing is then I want to take into consideration your debt to income ratios. And we're going to look at a few different variables there, including your current debt situation. Once I have all that information, I'm going to explain to you now the 2 options that you do have. One is to keep your existing home and then purchase another house, or sell your existing home, pull out the cash to pay off maybe some existing debt, and use that money for a down payment on another house. What I do differently than other mortgage companies, and especially banks and credit unions, is I use a software called Mortgage Coach. And through this software, I'm able to produce a report called a total cost analysis. And what it's going to do is it's going to clearly identify the pros and cons, and I help explain these to you, the pros and cons of either keeping your house and taking, let's say you rent out your house and you make $400 a month profit from rental income, what to do with that $400. Do you reinvest it into the mortgage? Do you use it to pay your new mortgage? Do you invest it into the marketplace in regards to the stock market? I take that information and I share it with you, and you can clearly identify which option will be best for you through that information. Same thing, I take the option where you have some cash proceeds from equity in your house to either pay off debt or put toward a house. I will give you my professional 2 cents, and then it's up to you to determine the right option for you. I hope this information helps. If this applies to you or someone you know, reach out to me. My number is on the screen, and I'd love to be a resource for you. I'd love to present to you your options and clarity around those options so that you can make a smart financial decision. I look forward to coming to you next week right before Christmas to wrap up a year. If you have any questions in the meantime, please reach out to me. Bye for now.